Video opens with you sitting in a comfortable, well-lit home office or living room. You're looking directly at the camera with a friendly and engaging expression. Hey everyone, and welcome back to the channel. Today, we're diving into a topic that has been gaining a lot of traction in the world of personal finance, peer-to-peer lending, or P2P for short. Have you ever wondered if there's a way to make your money work for you, beyond the traditional stock market or low-yield savings accounts? Well, P2P lending might just be the answer you've been looking for. So, what exactly is it? Imagine you could step into the shoes of a bank, but without all the overhead and complexities. In essence, P2P lending platforms connect people who want to borrow money directly with people who have money to invest that as you. Instead of your money sitting in a savings account earning a tiny fraction of a percent, you can lend it out to individuals or small businesses and earn a much more attractive return in the form of interest payments. It's a powerful concept that democratizes lending and borrowing, creating opportunities on both sides of the equation. Now, I know what you might be thinking. Lending money to strangers online. That sounds risky, and you're right to be cautious. Like any investment, there are risks involved. The primary risk is default. That's when a borrower is unable to pay back their loan. But here's the crucial part. Modern P2P platforms have become incredibly sophisticated in managing this risk. Let's break down how they do it. First, these platforms have rigorous vetting processes. They perform detailed credit checks, verify income, and analyze a borrower's financial history, just like a traditional bank would. They assign a risk grade to each loan, so you, the investor, can clearly see the level of risk you're taking on. A higher risk loan will typically offer a higher interest rate to compensate for that increased risk. This transparency is key, but the real magic of managing risk in P2P lending comes from diversification. This is the most important strategy you need to understand. Instead of lending your entire investment, say $1,000, to a single borrower, the platforms allow you to spread that same amount across hundreds, or even thousands, of different loans. You might invest just $1, or even less, in each individual loan. So, if one borrower unfortunately defaults, the impact on your overall portfolio is minimal. It's the classic principle of not putting all your eggs in one basket, supercharged by technology. This fractional investing is what makes P2P lending accessible and helps to stabilize your returns over time. Okay, let's talk about the exciting part, the returns. What can you realistically expect to earn? While returns are never guaranteed, many investors in P2P lending see average annual returns that significantly outperform traditional savings accounts and even some other types of investments. The returns often fall into a range of, say, 4% to 8% or even higher, depending on the platform and the risk level of the loans you choose to invest in. The best part is that these returns often come in the form of regular monthly payments, which consist of both principal and interest. This creates a consistent cash flow, which you can either withdraw or, even better, reinvest to take advantage of the power of compounding. Imagine your earnings starting to earn their own money. That's how wealth is truly built over the long term. So, how do you get started? It's surprisingly simple. The first step is to do your research and choose a reputable P2P lending platform. There are many out there, each with its own focus, fee structure, and investment options. Some focus on personal loans, others on business loans or even real estate. Look for platforms that have a long, established track record, transparent reporting, and positive user reviews. It's your money, so take the time to find a platform that you trust and feel comfortable with. Once you've selected a platform, the sign-up process is usually straightforward. You'll create an account, verify your identity, and link your bank account to fund your investment. Now comes the fun part, building your portfolio. Most platforms offer an auto invest tool, which I highly recommend, especially for beginners. You can set your investment criteria, things like the risk grades you're comfortable with, the loan terms you prefer, and how much you want to invest in each loan. The tool then automatically diversifies your funds across loans that match your preferences. This set it and forget it approach saves you a ton of time and ensures your portfolio properly diversified from day one. Of course, if you prefer a more hands-on approach, you can always manually browse through individual loan listings and pick the ones you want to fund. Let's consider a quick example. Let's say you decide to invest $2,000 using an auto invest tool. You might set it to invest a maximum of $10 in any single loan. Your $2,000 would then be spread across at least 200 different loans. Each month, as borrowers make their payments, you'll see a stream of small deposits of principal and interest flowing back into your account. If one or two of those 200 borrowers default, the loss is just a small fraction of your total investment, and it's often easily offset by the interest you're earning from the other 198 plus performing loans. This is the power of diversification in action. Now, it's important to have the right mindset. P2P lending is not a get-rich-quick scheme. It's a long-term investment strategy. You'll see the best results by staying invested for several years, allowing your returns to compound and riding out any short-term fluctuations. Think of it as planting a tree. You water it, give it sunlight, and over time, it grows strong and bears fruit. Panicking and pulling your money out at the first sign of a single defaulted loan is like digging up the sapling to see if the roots are growing. Patience and consistency are your greatest allies. Also, be aware of the fees. Platforms need to make money, of course. They typically charge a small service fee, which is usually a percentage of the interest you earn. Reputable platforms are very transparent about their fees, so make sure you read the fine print and understand exactly how much you'll be paying. These fees are usually quite reasonable when you consider the service they provide vetting borrowers, processing payments, and managing the entire ecosystem. To sum it all up, peer-to-peer lending offers a compelling opportunity to generate consistent, passive income and diversify your investment portfolio away from the volatility of the stock market. By choosing a reputable platform, embracing the power of diversification, and adopting a long-term perspective, you can build a resilient investment that works for you month after month. It's an innovative financial tool that, when used wisely, can be a fantastic addition to your wealth-building journey. Have you tried P2P lending? What has your experience been? I'd love to hear your thoughts and questions in the comments below. Let's start a conversation and learn from each other. Thanks so much for watching today. If you found this video helpful and want to learn more about smart ways to manage and grow your money, please give it a thumbs up and hit that subscribe button. Don't forget to ring the bell so you won't miss our next video. Until next time, happy investing.